Hello everyone. We are going to explore why derivatives are so important in the world of finance. While they might seem complex at first, they actually perform several essential functions that help the entire financial market run more effectively. We're going to break down these roles so you can see exactly how they contribute to the bigger picture. Let's start by looking at the three main pillars of the derivatives market. You can think of these as the core jobs that derivatives perform every single day. First, they help us figure out what things are actually worth through a process called price discovery. Second, they allow for risk transfer, which is basically moving financial uncertainty from one person to another. And finally, they help create market stability by bringing structure to trading. Each of these functions is vital for a healthy financial environment. Moving into our first core function, price discovery. This is just a professional way of saying the market is trying to find the correct price for an asset. To do this, the market looks at two different inputs: the actual valuation of the item right now and what the market expects to happen in the future. When you combine current facts with future expectations, you get a much more accurate and transparent price. It's a bit like how a car's value is based on both its current condition and how long people think it will stay on the road. Next up is transfer of risk. In any market, you have different types of people. Some, known as hedgers, are naturally exposed to risk, like a farmer worried about crop prices, and they have a low appetite for it, meaning they want to give that risk away. On the other side, you have traders who have a high risk appetite and are perfectly willing to take on that uncertainty in hopes of a reward. Derivatives act as the bridge, allowing the risk to move from the person who doesn't want it to the person who is comfortable managing it. As we move forward, it's also important to see how derivatives help the market evolve. Before these organized systems existed, a lot of trading happened in unorganized markets, which were often messy and full of unregulated speculation. Derivatives help shift those trades into an organized market space. What this means is that we now have surveillance and risk management mechanisms in place to watch over what's happening. By bringing these activities into a supervised environment, it provides a much needed layer of stability to the whole financial system. To wrap everything up, let's look at the big picture one more time. We've seen how derivatives create a continuous cycle that benefits everyone. They synthesize information to find better pricing, they efficiently move risk from those who need protection to those who want opportunity, and they move speculative activity into a supervised environment. When these three things work together, discovery, transfer, and stability, it ensures that the financial market stays robust and reliable for all participants.